Welcome back to the Data Driven Real Estate Podcast, the podcast for real estate professionals dedicated to driving business using data. I'm Aaron Norris, along with Sean O'Toole with PropertyRadar, and this is episode 36. On the show this week, we have David Erard of Armanino. Armanino is one of the top 25 CPA and business consulting firms in the United States, and David comes with over 20 years in the CPA practice with some very unique specialties in things like distressed debt and working with REITs. This week, we talk about a lot of changes happening in 2021 under a new administration, taxes at both the national and the state level, things that small businesses and real estate investors are worried about, and even down to 1031 exchanges and opportunity zones you will not want to miss this week. We are very excited today to have David Erard with Armanino. Welcome to the show.
Thank you. Nice to be here.
David, you have a very interesting specialty, which we'll get to in a second. But if people aren't familiar with Armanino, can you tell us a little bit?
Yeah, Armanino is a full-service accounting firm. We're probably mostly well-known up in Northern California, where the firm started and we're headquartered. But in the last couple of years in particular, we've started moving into different markets. So big presence in Southern California now as well. Started to move into Denver, Texas, Idaho, a few other just opportunities that we've really liked to get involved in some other cool spots throughout the country.
Okay. And you have spent plenty of time with the big four accounting firms, as they say. And I read your list of specialties, and it's pretty unique. I don't think I've ever seen this specialty attached to a CPA: distressed debt matters, real estate investment trust tax consulting. How on earth did you fall into these specialties?
Well, I worked, so I started with one of the big four and worked there for several years. And when moved to a different firm before Armanino, continued working with a lot of the same clients. And as those clients started to evolve, the way I think about it, in say 2006, 2007, 2008, a lot of the big players, because of the distress, started having difficulty raising new funds in kind of the areas that they had been focused on in the past. And so I started to see, at least with a couple of our clients, a big shift toward distressed debt and toward REITs. And so we went from really not working on any REITs, say in maybe 2007-ish, to having like our main client base being REITs and REIT focused and distressed debt focused funds. So it was a function of what, as the clients evolved and, reacted to the last downturn, we had to evolve with them and learn about REITs and distressed debt and just kind of learn a whole bunch of nuanced things. Distressed debt by itself is fairly nuanced. When you marry a distressed debt with a REIT or a real estate investment trust, there's a whole lot of other issues that come along with that. So it was really, call it a little bit of a baptism by fire back when we just had to keep up with our clients, or hopefully keep in front of them to some degree. We had to, yeah, had to go, had to really dive in and learn those things. And it was it was quite a challenge, but I've got to say it was really an invaluable learning experience, and has really served me and the team of people I work with very well.
Most of your clients on that front are still going to be larger. You're not helping the mom and pop investor for the most part. So you're working still with more institutional size clients.
I'd say as a general proposition, yes, the clients tend to be larger, but as with Armanino, we don't really have a specific client size we target. And I've worked with kind of firms that are just starting and doing their first deals. Also worked with like individual investors who might like a piece of property that's subject to a troubled debt. And so I've worked through a few transactions where that's one means of getting to the asset that people want. So yeah, by and large, I would say that space tends to be occupied a lot more by bigger players than smaller, but I've certainly seen smaller players go in and we've helped them navigate a few of the little nuances you got to deal with.
Yeah, interesting.
California is like New York when it comes to distressed debt. If you can do it in California, you can do it anywhere, right?
It's somewhat regulated, yeah.
So Armanino has, like accounting, tax, audit, et cetera. And where do you fall within that kind of, purview?
I'm a partner in our tax practice. My
Okay.
specialty is income tax, state taxes, federal taxes, REITs, private equity, those types of things. And I tend to partner with other partners within the firm who have the same industry specialty as I do. So we've got a really our audit practice, especially we do a lot of work with just with lending funds. Our consulting group on the technology side does a lot of work with private equity, starting to get a lot more traction with real estate. So it's really just within the firm. I'm a tax partner, but we try to attack things kind of on an industry basis instead of as I'm going to go in and try to be a tax guy and only help a client on a tax thing. Rather be a little bit more holistic. So hopefully I can speak well enough about some of the other issues that clients will deal with and know when I've got to bring somebody in. But we've tried to intentionally, me, Armanino thinks the same way as a firm. We're really not trying to come in and say be just a really good tax person or a really good audit person or a really good consultant. We're trying to come in and be a really good partner to our clients with whatever help they may need with their businesses. Some some firms are really big and sophisticated and have a lot of infrastructure behind them. They have people that deal with things. Others don't, and so we're trying to figure out. Sometimes our role is to coordinate with a very sophisticated CFO, who's really well versed in all of the tax and audit issues. Other times it's coming in with a firm that's just getting into a space and a lot of how do I do this type of questions.
That's great. Aaron didn't know this when he booked you, but I've actually been an Armanino tax client for many years. So,
oh, well, good.
Now you told me.
Glad to hear that.
So no gotcha questions. No.
No, that means I can.
I think it's the opposite, Aaron. I think it's fair game for anything.
Okay, great. How does it feel to be a CPA headed into 2021?
Oh, probably the same way it feels to be a lot of things heading into 2021. I think we're all having to adapt to things that are unique in my lifetime, certainly. With starting from with Armanino, we're really fortunate to have a really good technology platform to work from. So we've had some adaptation to people being outside the office and having to work remotely. We've been forced into that. Some of our clients, I'd say a lot more of the adapting has just been with clients who have tended not to have the best infrastructure and really like paper-based systems. And how do we get information when you're talking to somebody who might go into the office 1 or 2 days a week for a limited window to sign checks, and if they have time to get us the information we need to do the tax and audit work. So the adaptation has been a lot of different things. And we'll probably delve into some of those as we talk through different items on the cast here. But there's just been, I'd say, figuring out that probably the biggest challenge, quite honestly, is figuring out, we're able to get our jobs done day to day. So that hasn't really been the challenge. More just, how do we maintain our culture without people being together? How do we go out and meet people in the market when you're not able to meet people in the market? So just kind of adapting some things to make up for not the lack of in-person contact. And quite honestly, the in-person contact is really one of the more fun parts of any job. I think that's what makes any job worth doing. It's the clients you work with, the people you work with, the culture of the office, those water cooler discussions. So it's a lot of the adapting is just trying to figure out how to maintain some, make sure people know that we care, making sure that everybody's got different challenges because of the way we're having to do things and schools being closed. So just a lot of, I'd say we've trying to be as flexible as we can be and still meeting the needs of clients and without overwhelming people.
Real estate is a very paper heavy industry. So that's sometimes a challenge if you're working with clients that aren't paperless.
That is true. It's a little bit the opposite end sometimes of Silicon Valley, which has a lot of really new, a lot of slick stuff that they're really comfortable with. And I'd say for real estate, it tends to be maybe a little slower to adapt and take on new things in new ways. But we are seeing. But one thing I'm really pleased with is both on the client side and internally. I really am proud of the way everybody has been able to adapt and the way that we have been able to get through 2020. So going into 2021, I feel like we're still holding on a little bit and trying to get through the nuance of not doing things the way that we would like to and being in person. We've got a year under our belt of working this way, and I'd say it's at this point, it feels like we're closing in on the end of a marathon. We hope things get back to being the way they were, or whatever new normal turns out to be. Hope we get there sooner than later. And I'm optimistic about what I see with our people and our clients, but I'm also realistic about it's been a hard year, and we're just kind of still feel everybody's got a little bit of fatigue, both on the client side and on our team side.
What are the big, what are the most kind of common, especially among your real estate customers, what are the kind of common questions and concerns you're seeing now that are kind of unique to this environment? I'm sure PPP and how that works for, especially in the landlords and some of these other folks, and, tax credits around, or, forgiven rent, and, I don't know, other things along those lines.
Yeah, I would say it really depends on the type of real estate and maybe the market that the clients are in. Hospitality has a much different set of issues than multifamily. In the PPP programs and the relief packages, if you follow what those have been geared around, is keeping people employed. And so if you're just a lessor of residential or commercial property, it's not an employee heavy type business. And I'd say it's a lot of the PPP incentives really haven't been, call it, overly available to real estate. And the ones, the industries that are getting hammered really are getting hammered. The hospitality, it's very hard to, I think there's hopefully some sunlight ahead for that industry. But, for them, it's been one set of issues. And then for the multifamily, it's been a different set of issues. With multifamily, there's kind of a few things that are affecting them. One would be because of the way people are working remotely now. The market, a market or a location that would have been really attractive 2 years ago might not be. Just for example, if you had an apartment building near a convenient metro stop somewhere near a major city, would have been a trophy asset, right? Something that you knew, high demand for it. With the change in demand for public transit and people working more remotely, you might see a different set of things that people are really looking for. So instead of like convenience and access, you might be looking for a living space that also has a very convenient workspace. You might be, instead of somewhere with a really nice gym and really shared common features, you might be looking for something, people may not be as interested in having to share space. And so,
closer to open space. Park.
Yeah. So adapting to kind of changes in demand, because this is like, this type of demand change is something I've never seen. Yeah, it's there's going to just be some definite shifts in what kind of real estate people are interested in using. From an operating perspective, a lot of businesses who've had people working remotely now for a year are probably questioning what their real estate needs are going to be in the future. So it really depends on what type of real estate you have, which market you're in, what made the asset attractive before, and what might make it attractive now. And so just kind of adapting that way is what I see. Again, with my client base, I really haven't seen, I've seen a few cases where they've been really keen on the PPP programs, and there's a few clients that have really benefited from those. There's been a lot of clients who haven't, and there's a lot of challenges right now with stays on foreclosures or evictions and things like that. So people, if I'm handicapping at high level, depending on, it really depends on your facts and circumstances as to how much of an impact this had on you. If you had, as an example, a low income area, and you had tenants that may not be as concerned about credit scores and things like that, you're probably going to feel a bigger impact than somebody that has, a really nice building with really nice units that have good working spaces, because it's just there's going to be a little bit of a change in demand, and there's also going to be a little bit of a change in tenant behavior.
Right, right. What strategies are you seeing or suggesting, for those folks that are having, a hit and or, have that loss of income, and now maybe you're at a point where they're struggling to make their underlying debt payments? Is there any strategies there that's helping these folks in hospitality and the hard hit multifamily?
I think the one strategy I would always advocate is just be open and communicative with lenders and other parties if you have obligations that you're not able to meet. I don't think it's going to come as a mystery to anybody that, like, for example, if you're a movie theater, I don't think your landlord would be surprised if you were to start talking to them pretty regularly about what can we do here. But right. So, and by the same token, I think landlords have been a little bit concerned about being approached by people that didn't need help under the, so landlords are really trying to figure out who it is that needs help or who's just trying to get themselves, a little bit of a spiff. So one back to the original point, I think one thing would be just be open and be in communication with the people that you have obligations to. So that'll give you the best chance of succeeding, and getting them to cooperate with you. I certainly wouldn't ignore notices, as painful as I'm sure they are to deal with, and as sure, it stinks to not be able to meet your obligations. But I think being open and realistic about what you can do, and pulling whatever levers you can pull when you're really in trouble.
Yeah, I think that's great. Great advice. And it's interesting there how you said how some are just using it as an excuse to get better deals. I have a bit of commercial, and the only real tenant that gave me problems was my national credit quality, like the one that the banks want to see when they go to loan you money. That was the one that gave me trouble. All the local ones that the banks don't want to see, they were all great, worked really hard, worked well with me, and all the rest. And of course, the national credit quality tenant was the one that was a pain.
Yeah, it's interesting, and it's because of that dynamic. I think there's going to be a lot of landlords that are going to be skeptical as the first time they're approached. So I think if you have a consistent message and you stay to that message and you're doing everything you can and you're being transparent, that's probably the best path. Look for opportunities to get relief. I mean, there were some good tax provisions to be able to monetize losses that got put into some of the relief bills. So kind of monitor what options you have.
Can you walk us through those real quick?
Sure.
At a high level, not in super detail, but yeah.
Yeah, at a high level, very high level, the flavor of some of the relief bills on the tax side was to give the ability to monetize operating losses in a way that you hadn't been able to because of some law changes in 2017. So you were able to carry losses back that you wouldn't have been able to carry back under the existing rules. They took away some limitations on your ability to use business losses to offset other types of income and pay less tax. So just those types of things. And again, I don't want to go too deep into the weeds on it, but just the flavor was they tried to give a way for people to more easily monetize losses.
Like specifically there, right? So if you had, losses in 2020 where you were actually negative, you could go back and apply those to prior years and then actually get cash back that you'd previously paid in taxes.
That's right.
Is that a good way to sum that up?
Yeah, the perfect scenario would have been that you had a lot of income coming into, say, 2020 from prior year or two. And then in 2020, you had a loss that you were then able to carry back and reclaim some of the tax that you had paid.
Yep. Okay, good.
I know Sean gets asked this question almost every day. When are the foreclosures coming? You have a different perspective from the distressed debt side. What are you seeing?
Well, surprisingly, it's not going to surprise me that we see more of it. I think it'll trend that direction. I am actually a little bit surprised that we haven't seen more yet. And some of it has to do with stays, like I mentioned before. You know, I think it's a good thing, but it's hard to evict people and it's hard to foreclose on property with some of the relief things that the local governments are doing. So I think that's we may once those stays are lifted and once things part of it too is the courts. It's hard to get on docket right now, and it's hard to get things through a system that isn't working at full speed. So you may see more of that, and you may see more as a lender, you might see more of your borrowers getting into distress and looking for ways to exit. And so with distressed debt, you could look at it either as kind of on a single loan basis, how do I deal with a borrower who's in distress? Or more what I see more institutional players doing is might be looking at a portfolio of debt that an institution wants to offload, figuring out how to price that, buying it, and then working it as best you can. And so the opportunities I think are going to be for the folks who are smart enough to price it right and find a good opportunity. There could be all kinds of opportunity with distressed debt for attractive purchases. And again, if you talk to most private equity type firms, they would tell you that a lot of their gains are on the buy side more than the sell side. You got to buy things at the right price. So if you've got a good system and a good way of valuing debt and really being able to look at collateral and being able to, the deeper you can dive into the data and the more you're able to analyze it effectively, the better you can calibrate your purchase price. Say one difference I'm seeing, at least within my own clients now, say between now and the last downturn, there were just a lot of heavy distress with a lot of institutions really offloading things at a very attractive price from a buyer's standpoint. I haven't really seen that as much yet. Maybe it'll get there. I mean, from a more global perspective, I hope it doesn't get there. But just looking, so understanding how to price it, and then also understanding the nuances, at least from the tax side, the accounting side. Distressed debt has a whole host of issues that we think a lot about. And clients, I think, there's a little bit of a training or education on the types of issues that come along with that, because you need to understand like how these things affect you as the buyer. If you're going to be effective at working the best deal, there's times when you're also going to need to understand really how these same issues affect your borrowers or your tenants, so that what would the effect to them, and what the important things are going to be for them to negotiate.
Are you seeing transactions at all yet this round?
In distressed or just generally?
Distressed.
Starting to see, I've got a few clients that are launching distressed funds. So I am seeing some movement that way. I've got some clients that never stopped doing distressed funds, so they're going to keep doing it. But I would say I haven't seen quite as much of a lurch in the direction of distressed as I did the last time around, but it might be a little too early in the cycle still, and we may get there.
Yeah, I got a lot of calls last March of like, hey, Sean, we used you last time and I'm starting $100 million fund, or, a $500 million fund, and we're going to go out and buy. And I'm like, maybe a little early. And that was a year ago. So, and it still doesn't feel like it's really coalesced yet. And I'm not 100% sure. It's not as clear to me that it will, but it'll be interesting to see. I mean, yeah, you think you would have seen some like in hospitality or something by now, but it seems like, banks and everybody's being pretty patient so far.
Yeah, surprisingly patient, to be honest. There hasn't been, in the last time, 2006, 7, 8, 9, whichever year you look at, I think there was a little bit of an overreaction and a knee jerk, and that created its own set of issues. I'm actually impressed in a good way. I really haven't seen that much this time around, and maybe we learned something a decade ago, or maybe there's other reasons for it. But we're not at a point yet where I see like distressed debt being, everybody's doing it type of thing.
Yeah.
It's been more targeted by clients who have had experience with it.
Well, certainly the regulatory framework changed the last time around from forcing lenders to get bad assets off their book as quickly as possible to forcing them to make every accommodation possible to borrowers. So that alone tells me it's going to take on the residential side quite a bit longer. Of course, the rules didn't change nearly as much on the commercial side.
Yeah.
Do you see any
Agree with you.
specific asset classes that people are raising money to really go after that they're excited about?
There's some, like I mentioned, some starting to look to launch distressed funds. I think others are really looking at, there's all kinds of funds that are being launched. And so I think it depends on what the expertise is of a given client. I can't say I've seen one, I can't say I've seen all of my clients migrating in the same direction or looking at the same asset class. Multifamily has been really strong for the last decade, and I see it still being strong. It's very, desirable asset class that I see a lot of. But for 2020, it was a pretty quiet year until we got close to the end, and then started seeing, a lot of deals closing close to the end of the year. I think that trend will continue. I think, now that people maybe have our legs under us and probably in a position to make some decisions, I think you'll start seeing more activity. And I don't, guess one reason I'm on this side of the desk and clients are on the other side is maybe I'm not quite seeing what they're seeing as far as where the real opportunities are yet. But I would expect that there's going to be, in the industries that have been the hardest hit, hospitality, like we talked about, maybe some of the commercial buildings, particularly, not so much industrial, but, office. I think you'll see some real tweaks there to what people like, how the office spaces are configured, what is a good target asset. You might see different plans. We've talked to some architects and engineers about, the types of conversations they're having. They've been through a year where a lot of it was repurposing space to put people farther apart, have less people in the office at the same time, more sanitation type stations. And so having, I think, the open plans where you have 100 people in a room and in a war room, that doesn't, that may be going the way of the dodo, but again, I think it's
to some degree. I mean, there's plenty of studies saying it's just not a great way to work and concentrate. It takes us something like 15 minutes after an interruption to get back into the zone. But so yeah, very interesting. I'm going to shift gears just a little bit and talk about, some of the changes we might see coming. I think, one that gets talked about a lot is elimination of the 1031, which is part of Biden's, proposed tax changes. Did you see a lot of movement last year of people saying, well, I don't think that's going to happen, but it might. So I'm going to move some stuff around, or people kind of haven't been too worried about it? What have you seen? Any action by clients around that?
I've had a number of clients that did 1031 exchanges, but I'd say I thought it was more in the normal course than it was specifically because they were concerned about losing the opportunity. Okay. I think it's certainly something for people to keep an eye on. I haven't really seen anything formal on that yet, other than proposals. So if it starts to get real traction, then certainly be aware that may accelerate some 1031s, or that may prevent some 1031s from happening. But I would say, at least from what I've seen so far, the notion that it may go away hasn't really changed behavior. But maybe that is in part because we've heard, it's been several years now that I've continue to hear that that's something they're looking at taking away. And there might be a little bit of a, boy who cried wolf type of feeling, where it's been, yeah, you've told me I'm going to lose it at some point. If I lose it, I lose it. But we're aware of that. So I'm not really seeing a huge reaction to it. But once once pencil meets paper, and or I guess the computer version of that, bills are written, we may see some change in behavior and people wanting to accelerate those. But to date, I have not seen the potential loss of 1031s driving a lot of people to do them.
Okay. And what are the chances? I mean, I was shocked. I was actually benefited from one of these, but shocked that sometimes when these, tax law changes go into, effect, they can be retroactive, So you're doing a 1031 exchange right now. Let's say this gets a bunch of steam on it by the end of the year. What are the chances that it's retroactive for, 2021? Is that something you see happen a lot, very often, very rarely?
Very rarely on the federal side have I seen things take retroactive effect. Usually there would certainly expect some notice of that if that was the intention. But some states like California have been a little bit more, or let's say maybe a little bit less considerate about making things retroactive. But on the federal side, I would expect, if I'm handicapping it, and this is not insider baseball because I don't know, but if I'm handicapping it, I would expect any change like that to be effective on the date of enactment, or maybe they'll give a small window and they'll say maybe starting in 2022 that's no longer going to be part of the code. That's what I would expect.
That happens. There's a gold rush. I mean, there'll be a big rush to move stuff around. It'll be really interesting. So it's something for our investor customers just to keep an eye on, both for their own interests and for all the activity that might happen if it does leave a window.
Yeah, and I think another thing for investors to keep their mind on, which is eyes on, which is in the same kind of vein. I'll try not to be political here, but I would say it's not hard to overlook the fact that the former president was a real estate guy, and that there's a lot of people that don't have the most favorable opinion about the former president. And so I think there's going to be maybe some political wind to do things that would be detrimental to real estate, be in reaction to that. And I just I'm not certainly a political analyst or anything, but I think with the prior administration made a point of kind of undoing and poking the eye of the administration before them in a few things that they changed. So if you believe like I do that there's a lot of childish like motivation in some of the politics that we see, it's not hard to imagine that there's going to be a few changes coming down the road that are not going to be favorable for real estate.
Yeah, I worry about that a little bit. My only consolation, or that I take there, is that there's an awful lot of powerful Democrats that are heavily invested in Pelosi's husband, plenty of others that are very real estate heavy too. So fingers crossed we're safe, but yeah, you never know.
It's just kind of just a question of whether I know it hurts me, but it hurts you more, so I like it. It could be the flavor.
Ouch.
I've been trying to follow all the changes. So the CFPB is reviewing qualified mortgage rules. I'm interested to hear if a state taxes changes at all. And here at the state of California, a reporter got back to me today about AB 1199, an excise tax on property owners in California who own more than 10 properties. So real estate is
rental income.
Yeah, rental income. So they're definitely, real estate is seen as that bucket of some money that they can go after. With rent control things in place, it could definitely put the squeeze on some investors. Do you take a lot of questions from real estate investors that are nervous about not just national but state tax regulation?
Oh, for sure. And I don't think that's limited to real estate. I think there's, one of the reasons I think, a California or New York, some of the states that do impose a lot of income taxes and other taxes, I think there's going to be a lot of questions about whether people want to stay there and whether businesses want to stay there. So not so much specific to real estate, but just as from the regulatory environment to the tax environment to the desirability and affordability, there's just a lot of reasons why people are maybe looking at different markets as being attractive. I mean, I see Idaho, Utah, Texas, Florida. Don't mean to limit it to just those states for any of your listeners who live elsewhere, but there's a lot of states that I think are seeing a lot of new residents because of they offer what the people moving out of these certain states see as a better opportunity and a better environment to live and run a business.
But then they move there and find out they're in the same financial situation. So maybe you should expect some things happening there as well. I don't know. Right? Las Vegas, right?
A lot of those states are not in great shape
Right.
either, right? I always love how California gets called a welfare state, but it's one of the few states that contributes more to the federal government than it takes. So most of the states calling California a welfare state are actually welfare states.
Is Las Vegas still considering an income tax? I forgot to look at that before the show. Nevada, yeah.
But it takes a constitutional amendment anyways.
Oh, okay. Yeah. So doesn't mean that's not going to happen in another state. We're all sort of facing these holes in budgets is I guess the point. So
I agree with you. And I think the thing that people might want to keep an eye on is just there's a lot of trends that are emerging from, in reaction to the last year and a half. Some of it I think was underway a little bit where people are looking for ways to escape high tax, high regulation. That trend is going to continue. Another part of it is, and maybe adds on to it and snowballs it a little bit, is with people, companies now discovering that they can do this with a remote workforce. And I think there's going to be less importance on maybe where the workforce is located. And there's just a little bit of a different business dynamic, as well as, some other things that I think will contribute to growth in some of these other states.
Do we think being able to write off state taxes will come back?
Honestly, if I were trying to advise the Democrats, I would certainly say that that's something that would be viewed favorably by most of their constituents. The flip side, I suppose, is if you're advocating the other direction, you'd say, the rest of the country maybe shouldn't be subsidizing higher tax states for charging higher taxes and reducing the federal taxes of their residents that way. But honestly, if I were advising the Democrats on this one, I would say, that's something you should really look hard at, because it would be viewed very favorably by a lot of people that support you.
Okay.
Yeah, I think we'll see that one come back. And the argument, that is on the other side is a little bit of a red herring, because most of the states that benefit from SALT are actually the ones that contribute more to the federal government than they get in return. So despite the feeling that it contributes less, I don't know how true that actually is.
Yeah, and by the way, I think most political arguments are red herrings, so I agree with you.
I'm just curious, opportunity zones. Do you have a lot of clients that took them very seriously? I think a lot of California investors I know got excited. They read it and they're like, oh, California doesn't apply. I have to pay taxes now. Did you have a lot of people dig into that or shine it on?
No, I think it was a very popular thing, actually. And it's one of the few things I can remember in the last decade that's gotten a lot of bipartisan support for it. And even if you don't have, say, a state benefit, the federal benefit might be compelling enough for people to do it anyway. Because the way that program works is you end up deferring the tax on the gain from, say, the first sale that gives rise to the gain that you reinvest. The real benefit of the program is that when you have the second sale after you've been in for 10 years, you don't pay federal tax on that gain as long as you've met all the requirements. And so I thought it was a really clever, really intriguing program. And I have seen quite a bit of interest, both from clients who want to invest as well as from clients who want to set up the funds and bring investors in.
Aaron's also done a good job of pointing out that it doesn't have to be like kind. And so you have this ability to transfer, asset classes and move. And that also, I think, is an underappreciated piece of that.
I've had quite a few conversations with crypto and Tesla stock owners for some reason. I don't know why.
Yeah, and if you, one other nuance, if you compare it to a 1031, is with the 1031, you have to reinvest everything. And the first dollar that you don't reinvest is taxable kind of on down. So 1031, you really have to reinvest everything, where with the Opportunity Zone program, you only had to reinvest the gain portion. So the
Wow.
big that was a really big attractive thing because it required a lower investment in I just thought it was, again, I thought it was a very clever program.
You transfer your gain out and then, but you can put the basis back in your pocket.
Yep.
Interesting. I didn't even know that one. So that's great.
Early on, I was doing some research on it, and I interviewed some people in downtown Riverside, where I live, is an opportunity zone, and it happens to be our mayor's innovation district. So a lot of attention. I met with economic development people, and I happened to know a lady in town that was buying a lot of real estate. I asked her, I'm like, do you know about this? And she's like, I have no idea what you're talking about. And then I talked to a few businesses I knew were moving into her building. I'm like, if you're raising money, do you realize that you could be raising money for your small business? You don't have to own the real estate. You could be doing this. They're like, no idea what you're talking about. I just don't think the word ever got out. So you could have two businesses taking advantage of opportunity zones and nobody was paying attention. It's sad.
Yeah, and it's tough because it, with as with any program, and I'd say the same thing of the PPP and some other things, they get so difficult to administer, and there's so many like foot faults and steps that you have to manage. So I think part of it maybe people weren't familiar with it. Another part of it might be people hear about it and start to look into it and realize, wow, this is really going to be complicated. And so there's probably a lot of people that get driven away from programs they could benefit from simply because they are necessarily so complicated.
Some things I would definitely like to bring up to ask you, because I need a reminder. I've had some people in 1031 exchanges think that I didn't identify in 45 days. You know what? I'm just going to do an opportunity zone. From what I understand, that is not the case. You can't switch from a failed 45-day 1031 exchange and flip it to an opportunity zone. You would have to do that before the 45 days identification period.
I'm actually not sure on that one, because I think with the Opportunity Zone program, you actually have a window of time after the gain is originally recognized to reinvest. I'm not sure if you have I'll call it a busted 1031, where you go into something intending to do it, and then for whatever reason you can't. There you'd normally have it's just a taxable transaction instead of a 1031 exchange.
Okay.
So I'm not aware of a restriction on being able to then turn around and take that gain and put it into an opportunity zone. It's possible that there is a limitation I'm not thinking about, but I'm not aware of one.
Because of the hot market, I only want to bring it up because the opportunity zone, you actually have more time to identify, and then also you have to do a fair amount of improvements. Can you mention that? What is it? You have to improve it by 50%?
Yeah, I think you have to put in 50, it's either 50 or 100, and I'm sorry, I don't remember, but you have to spend a lot to renovate, or you have to put a lot of money into the asset. So it isn't like you can just go buy a rental building and start renting it. So you actually would have to go in and make some substantial improvements to the building part of the property. You have to put money into the business. So it isn't just that you buy something and you're good. You actually have to, there are some steps you have to take. And drawing a little bit of a parallel to the REIT rules, REITs have these income and asset testing requirements that you have to meet. There's something similar to that in the opportunity zone world, where you have to look at income and asset testing and make sure that they're complying with the op zone requirements. So
Does
just
that land
people
on
should,
your desk? That's a lot of work.
oh, it does. Some of those do, and others, I have clients that invest, and we also represent a few firms that are doing the opportunity zone funds.
Mm.
So from a testing standpoint, advising, telling them when they need to do what, it has been a bit of a challenge, because especially with some of the well-intentioned COVID relief bills, the periods that you have to do things kind of shift a little bit as they give you a little bit more time to do X or Y, because, from say March of last year to July of last year in particular, the world was a little bit frozen. So, yeah, we get involved in helping people manage through that process, but it just, people should be aware that it is a process.
I was fascinated because they launched the opportunity zones and they continued to legislate around it. So they launched it and they kept on changing the rules. That's very uncomfortable.
Oh, it is. But if you look at that tax bill from 2017, it was a very significant bill. Yeah, we were still getting guidance on some of the more complicated provisions in January of this year. So, and it's not just opportunity zones, it's all of it. Whenever you have a really robust tax legislation, the guidance that follows that is going to be coming out for years.
Right. And then some cases probably, and the rest even after that.
Yeah, and probably a little bit early for cases on anything right now, and especially with the courts being,
Yeah.
not working at full steam. I think there's gonna, like, the normal judicial type of guidance that you might get, you're not going to see in a normal kind of cadence.
Yeah. Yeah.
Don't want any clients that become a case, right? That's not always a good thing.
Yeah, unless they win, then you're happy about it. But you'd rather not fight the battle if you don't have to.
For sure.
You don't want to be the subject of a private letter ruling.
Yeah, not an unfavorable one for sure.
Yeah.
No, opportunity zones have lost some benefits. If you did an opportunity zone, was it by the end of 2019? There was an opportunity to get, was it a 15% credit towards the taxes owed? Is that how that worked?
Yeah, so what they did was, if you, just because of the way the program was laid out and the timing, if you invested, I think it was before the end of 19, 15% of that gain that you originally recognized, you got a relief. You didn't have to pay tax on. I think it's dropped down to 10% or 5%. So there's a little bit less of a spiff as time went on, which made it a little bit of a balancing act between, do I dare kind of do this not knowing what all of the rules are yet, but knowing I want the full spiff, or do I wait and see, make sure I really understand the state of play, have more defined rules, and understand that I'm going to get the trade-off is I'm going to get a little bit less of a benefit.
You still have people contacting you about the opportunity though?
We do.
Good.
Yeah.
Okay. What other opportunities are real estate investors bugging you about these days?
Oh, I think everybody's keeping a close eye on what happens with tax legislation. So I think the general feeling is that tax rates are likely to go up and not down, and understanding whatever carve outs there are is going to be important. The carried interest has been another one, something like 1031 exchanges that we've been hearing about for quite a while, that people, that tax break may be taken away. And for those of your listeners that aren't familiar with that term, I've heard it called carried interest or promote, or profit participation. There's a few different ways you'll hear it. It has to do with normally a fund sponsor. If their deal is successful and everybody does well, the fund sponsors do better as the deal does better. So a fund sponsor might get 5% of the profits if the deal is like successful but not great, and they might get 20% of the profits if the deal is really good. And the numbers vary by deal and by sponsor, but the idea is that the better the deal does, the more the sponsor earns as a carried interest or a promote or profit. And so there's been the notion for a while now that whatever they're earning really should be considered earning, and not something that's the equivalent of a capital investment. And so that's of all of the things I guess I'm getting the most questions on or hearing the most about. It's probably how likely is it that they actually make those rules effective. The 2017 had a bill that they did look at things of like a 3-year holding period or less, as being subject to not to capital gains rates, but to ordinary rates for certain situations. Real estate wasn't as affected by that as maybe a hedge fund would have been, because of the type of gains you would get on a real estate deal relative to a hedge fund that's selling securities or something like that.
Right.
So getting a lot more questions now about how likely is it that rule changes? What should I be ready for? Do I need to tweak my agreements? How should I be thinking about things? I'd say of all of the topics that I'm getting questions on, it's like where are tax rates going? What are going to be some carve outs, or are there what benefits do you expect us to lose? And then at the top of that list is will carried interest end up on the chopping block, and are we going to end up being treated as ordinary income on that instead of capital or Section 1231 gain, which is the way it's worked historically.
So you're offering therapy sessions like right after CPA sessions, I see.
Yeah, or just happy hour. I don't know.
How are you communicating all this? There could be a lot of change this year. Do you have a plan on how you're wanting real estate investors to plug in and sort of figure out what's going on?
Yeah, I'm trying not to cry wolf on stuff. So if you pay attention to the news every day, your life is going to be a lot more stressful than it is if you pay attention to time or have somebody monitoring the right things for you. So one thing I'd tell people is maybe don't pay attention every single day, but when there's news of a proposed bill or something starts to look a little bit more formal, we'll certainly be communicating that with our clients, letting them know what we're seeing and hearing. Like I said, hasn't been a whole lot that I felt like I had to communicate yet, other than there's a lot of changes that might happen when they do, and as these things get more clear, we'll let you know. But I worry a little bit about taking a proactive step to something that you don't need to. And don't mean for that to sound bad. It's good to be proactive and not reactive, but you also maybe don't want to go through the expense and brain damage. You don't want to change your business. You don't want to make a hasty decision because you're worried about what might happen. So I'd say I would try to tell people to stay the course, focus on running the business as well as you can run the business. Do the best that you can. And if there's a situation where we start to see something concrete, definitive, then if there's a need to plan around that, we'll do what we can. But again, I would try not to get too focused on possible changes and stay focused on making sure you're doing the best you can running your business.
Very good.
That's great.
Anything else we should know headed into 2021 before we end?
Oh, I wish I had something smarter to say. That's just, I think the biggest, again, from a business standpoint, I think just, I worry the most about preserving culture while we're all working remotely. And I think, we've been on survival mode and we've been able to stay the course so far. But, from a culture standpoint, from a people standpoint, best advice I can give is people really matter. On the client side, your team really matters. Relationships really matter. And so we've kind of, had to put some of maybe the normal relationship management stuff that we would do on the side because we can't be, we haven't been able to be in person. So I'd say, going into 2021, I would just want everybody to be mindful about how 2020 has affected all of us, and really be aware that ultimately everything we do is centered around people and making sure we're doing the right things for people. And it's probably the best advice I could give.
Sounds good. If people want to get a hold of you, where should they be going?
So you could find me on the Armanino website. That's ARMANINOLLP.com. Name is David Erard. It's a funny last name, ERARD. Or if there's a way I can send you an email address to put up, or but it's just my first name, david.erard@armaninollp.com. If anybody wants to reach out. And my phone number is 949. Hang on, sorry, I'll have to look it up actually because I don't call myself very often. The phone direct dial would be 949-396-1551.
That's good.
Thanks so much, David, for joining us.
All right, thanks a lot.
Appreciate it.
Thank you for listening to the Data Driven Real Estate Podcast. You can find show notes and links to some of the resources mentioned in the show at datadrivenrealestate.com. Click that Join the Community, and you'll be forwarded to the PropertyRadar community where you can ask questions about the current show and even see upcoming guests and ask questions there. We'd love to engage with you in the community, so check it out. Please don't forget to like, favorite, subscribe, and share on your favorite platform where you're listening to the show. It helps us out a great deal. Thanks for listening, and we'll see you next week.